For thousands of years, gold has been the ultimate symbol of wealth, of security. But what about today? In a modern portfolio, what is gold really for? Is it that critical emergency exit you need for when the markets go sideways? Or is it just a beautiful golden cage that traps your capital and stops it from growing? Well, that's the big question we're going to tackle right now.
So, first off, why gold? What makes it so special? It's not just that it's shiny. Its value comes from a few really fundamental properties. For one, it's rare. You can't just print more of it like you can with money. It's also incredibly durable. I mean, it's practically indestructible. Gold from Roman times is still with us today. Plus, it's universally accepted, pretty much anywhere on the planet. And maybe the most important part? It's tangible. A gold coin in your hand is not someone else's IOU. It can't go bankrupt. There's no default risk.
And history shows us that these qualities really, really matter when things get scary. Just look at the timeline. The Great Depression in the 30s, the crazy inflation of the 70s, the 2008 financial meltdown, and of course the shock of the 2020 pandemic. In every single one of these major crises, as faith in currencies and the usual investments crumbled, the price of gold shot up. It has a heck of a track record as a financial life raft.
So let's really dig into that idea first, the idea of gold as the ultimate emergency exit. How exactly does it shield investors from the kind of chaos we see in the world today?
A huge piece of the puzzle comes down to what you might call the fear factor. Seriously, you can almost think of gold as a barometer for global anxiety. When investors get nervous, when they lose confidence in governments, in banks, in the whole system, they tend to run to gold. And all that demand, well, it pushes the price way up.
So what kind of fear are we talking about? Well, first, there's high systemic risk. That's the worry that the whole financial system is fragile, that a big bank could fail. Second is a loss of confidence in fiat currency, money that's only backed by a government's promise, especially when central banks are firing up the printing presses. And third, you've got rising geopolitical tensions, wars, trade disputes, things that create massive uncertainty. These are the big triggers that cause that flight to safety.
Okay, so if you're thinking about owning gold, there are basically two ways to do it. You can see the breakdown here. On one side, you have physical gold. We're talking bars and coins. Its biggest pro? Tangibility. You can literally hold it in your hand. But there are downsides. It's harder to sell quickly, so liquidity is lower. It often comes with a high initial markup, and you have to figure out how to store it securely. On the other hand, you have paper gold like ETFs. It's the total opposite. You don't hold anything physical, but you get insane liquidity. You can buy or sell it in a second. The costs are way lower, and a professional custodian handles the security. So it's really a trade-off between having that physical control versus modern convenience and cost. So it really does sound like the perfect insurance policy, right? An unbreakable shield for a financial storm. But, every insurance policy has a premium. There's always a cost. So what exactly is the price you have to pay for that golden protection?
And that brings us to the other side of this whole debate, the idea of the golden cage. This is all about the hidden cost of owning an asset that doesn't actually do anything.
And this is the absolute crucial point. Gold just sits there. It's a non-productive asset. A bond pays you interest. A stock can pay you a dividend. A rental property generates, rent. Gold does none of that. The only way you make money is if, down the road, someone else is willing to pay you more for it than you paid. You are 100% reliant on price appreciation.
And this chart really drives that point home. What you see is that during long stretches of economic growth and stability, productive assets like the stock market are almost always going to outperform gold, and often by a lot. Look at that gap. That difference between the S&P 500's return and gold's return, that's the growth you gave up. That is the opportunity cost of playing it safe.
And that's why going too heavy on gold can be a real trap. It kind of breaks the first rule of smart investing, which is diversification. During the good years, and let's be honest, most years are good years for the market, a big allocation to gold can act like a lead weight on your portfolio, holding you back from the compounding returns that really build wealth.
Okay, so we've heard the bull case and we've heard the bear case. Let's push past the hype a little bit and separate some of the common myths about gold from the more complicated reality.
You hear it all the time. Gold is a great hedge against inflation, right? Well, yes and no. It turns out it's a fantastic hedge against a specific kind of inflation, monetary inflation, the kind you get when a government prints way too much money. But it's actually a pretty poor hedge against cost-push inflation, like when a supply chain shock makes everything more expensive. So, where the inflation comes from makes all the difference. Now, if there is one relationship you need to burn into your brain about gold, it's this one right here, the inverse relationship with real interest rates.
Think about it. When you can buy a super safe government bond that pays you a good return after inflation, gold starts to look pretty bad. Why would you hold a yellow rock that pays you nothing when you can get a guaranteed positive return somewhere else? That's why rising real interest rates are like kryptonite for the price of gold.
So is gold really this magical asset that zigs when everything else zags? Not always, but it tends to do it when it matters most. It's what we call weakly to negatively correlated. And that's just a fancy way of saying that during a full-blown panic, when stocks and sometimes even bonds are all falling together, gold often does its own thing, or even goes up. That behavior is what makes it such a powerful tool for diversification.
All right, let's bring it all home. With all this information, how can you make a smart, strategic decision about whether gold belongs in your own portfolio? Well, most financial advisors are going to recommend a pretty modest slice of the pie. We're typically talking somewhere in that 5 to 15% range. Now, if your main goal is just to preserve your wealth, maybe you'll lean toward the higher end of that. If you're younger, you've got a high risk tolerance and a long time horizon, you might stay on the lower end, or maybe even decide you don't need any at all. If you do decide to invest, here are 3 really sensible steps to follow. Number 1, define its role. Be clear with yourself. This is portfolio insurance. It is not your main growth engine. Number 2, think about using modern tools like low-cost ETFs. They're just easier and more liquid. And number 3, rebalance. This is key. It forces you to sell a little bit when gold's price is soared and buy a little when it's down. That's just disciplined investing.
And before you buy a single ounce, you've got to ask yourself these questions. And be honest. What exactly are you trying to protect against? A full-blown currency collapse or just a normal market correction? What's your time horizon? And maybe the most important one, are you buying this based on a clear, calm strategy, or are you just reacting to scary headlines?
So we come right back to our central question. Now that you've seen both sides of the argument, you can make the call. For your financial goals, for your view of the future, is gold a critical emergency exit you can't afford to be without? Or is it a beautiful golden cage that will only hold your money back? The choice is yours.